Hello, thanks for joining us today. This is Donna Bauer, the original note buyer, and I am very excited because I have a special guest today. As you know, I have always told everyone that one of the first things you should do when you get involved with notes is to set up a self-directed IRA, because everything that I teach can be done in an IRA as long as it's self-directed. And there are lots of companies out there, but I am happy to present to you my very good friend, Carl Fischer, who is with CamaPlan. Carl, are you there?
I am. Thanks, Donna.
Well, I'm so glad. I appreciate your taking this time out to share some ideas about self-directed IRAs with my students. And I was thinking, I I don't know how long we've known each other. I'm thinking about 15 years or so. Has it
Yeah,
been that long?
I think it's been that long. It might even be 18 years because I think it was around 2000 when I first ran into you.
Okay.
I
Well,
didn't think you had any grandkids at that point.
I definitely did not.
Yeah.
I definitely did not. But so I'm, and the other thing is, I want people to know that Carl does notes. He's done notes for years, and so besides having one of the best self-directed IRA companies out there, he also understands note investing, which is huge when you're going to be buying notes in your self-directed IRA. I switched to CamaPlan primarily because, not primarily, for two reasons. Carl, because of you, and because the fees are low. And so for people who are very money driven, or watch your spending, you will particularly like CamaPlan because the value that you get, because Carl and his team really know their stuff, and because the fees are very reasonable. So that's my 2 cents. And Carl, my plan is just to turn it over to you and let you run with it, if that's okay with you.
Sure, I appreciate that, Donna, and I appreciate you telling me that about the fees. And my sister and I run the company, and we're both investors, so we did set up our fees so that we thought it would be fair for investors, by investors. So let's get started here. Basically, I'm going to tell you this disclosure: CamaPlan doesn't provide investment advice, or it doesn't endorse any products. And all the information materials that I'm going to talk about today, I've pulled out of mostly IRS documentation, and it's for educational purposes. But I want all of your listeners to know to do their due diligence, and if they're not good at it, I encourage them to consult with their attorneys, accountants, or financial advisors before they invest in any investments from that aspect. So I just want to try to keep it in that vein. Always do your due diligence. Um, so today we're going to talk about what I think is the best wealth building technique. Most of our clients find a 20% to 50% increase in their income or value of information for that within each year on what they make. And I'll tell you what it is, why you want it, and who can use it. But I'm going to tell you right now, many people say it sounds too good to be true. And when I first heard it, 25 years ago, I thought the same thing. I couldn't believe it. Very few individuals or professionals know about it. The very wealthy have been using this strategy for decades. Mitt Romney had to show his tax filings, and he had a self-directed IRA. They don't teach this in the universities, none of them that I'm aware of. And you're not going to hear any of this information from your professional advisor. But I'm going to tell you, I've been working with this since the early 1990s, and it was around since the late 70s. So I don't think that many people have a hard time believing that it's still doing that. How did I get into it, and who am I, and why is this? Well, I was born in New Jersey, but my parents moved to Lauderdale when I was very young, 2 years old. I went to school and grew up in Lauderdale. I went to Cornell University up in Ithaca, New York, graduated as a structural engineer. went down to Cape Canaveral Air Force Station, Kennedy Space Center, worked on launching the shuttle, the R&D, and then the operations of it. After the CamaPlan, I found out about, starting the IRA company in 2004. And I've been doing that ever since. My mom and dad were in real estate and in notes. I started doing those basically. I started real estate in 1976, owning my own real estate. Worked with my mom and dad's and their mom and dad's prior to that. I got tired of paying taxes. I found out this guy was there. I've been married for 36 years to my wife, Vicki. I've got 4 boys and I've got 5 grandkids. Not quite as many as you do, Donna, but we're still working on it.
Hey, I hear you on that. You know, I had forgotten that we both have 4 boys. That's another thing we have in common.
Yep, I didn't forget it. But yeah, so the other thing that is there is I do want to tell everybody that I am biased towards tax-free accounts, and I'm biased towards real estate and notes. I put real estate up there instead of notes because I always want to have my notes secured. I try not to do any unsecured notes, and you'll probably see some of my bias come out in my presentation. It doesn't mean that it's right for you, but it is right for me in many instances.
And I agree wholeheartedly with you.
Yeah, and a lot, half the country does, and then the other half always say defer, defer, defer. And you can talk about that, and you can use as, an IRA and deferred if you want, but I'm going to primarily talk about the power of tax-free investing today because we only have a couple of minutes. So the first thing I ask people is what's their largest expense in their life, and I hear car, I hear house, I hear kids, I hear ex-spouse, but in reality, when you add it all up, your biggest expense is taxes. So once you understand that, it's not so much you make it because they make all these different rules and all these different taxes hit you a little bit at a time, so you can't fight them all. So you take kind of the first one, and that's the Fed income tax, state income taxes in a lot of places. So it's not necessarily how much you make, but what you get to keep. And that's what I want to drive home to people that are watching this presentation. And this slide kind of does it. And for an example here, this was, one of the women came in and said, is this kind of how this is going to work? Because she was putting $16,000 in one of her son's Roth IRAs when he went to college, and wanted him to have money when he was going to retire. So she put in $16,000. She said, I'm going to make around 10% rate of return, and I'm assuming my son will be in a 30% tax bracket at this point. And all this stuff changes, right? Because Donna, I've seen some of your notes where you make way better than 10% rate of return.
Absolutely, it varies.
Right. So the more rate of return, the bigger the difference this is going to be, and the higher the tax bracket, the bigger difference you'll see there. And obviously, the more money you put in, the more you'll see. But in this example, if you take an account that's taxable, which is in the blue on this slide, and you take an account that's tax-free, it's in the green. So if you go out 40 years for this college kid, and they made 10% for the 40 years, in the tax-free account, you'd have $1 million. And the one that was taxed every year, you'd have 300,000. So by filling out a form and using your Roth IRA or your health savings account or some other tax-free account, you can, in this case, triple your money, in the same period of time.
That is huge, and I don't think most people get that. I'm so glad that you put this graph up to show people, because when you can see it, I think it really hits home.
Yeah, well, any financial advisor can do this graph for you, okay? And some of them will say 10% rate of return is too much. They want you to do 7. I have other people that say, hey, I don't make less than 15. And you know what you make, Donna, on these notes. So all this stuff, you can make this chart for whatever you want. You can ask your financial advisor. You can ask us. We've got an Excel spreadsheet that'll help you do this. But go to your own advisors and just check out what I say. I always say, do your due diligence. Do it on us too, and just have them look at this and see if they believe the numbers, and if their own advisors will have them do this. So obviously I want you to do the tax-free. Here's another way of looking at things. Everybody's buying groceries, housing, car payments, and gas. And Donna, when your 4 boys were at home, what your grocery bill was, and you know what it is today when you're by yourself. It's a lot less. So everybody has different numbers. But let's just say between groceries, housing, car payment, and gas, you need $1,560 per month, or $18,000 for the year to kind of live. And let's say you make $35,000 a year. That's your salary at a W-2 job. Out of that $35,000, because of taxes, you need $1,985 each month instead of $1,560. If you make $70,000, you need $2,100 a month because of the federal taxes taking out, because the more you make, the more they take. And if you're making $178,000 in your W-2 job, then you need $2,400 each month to buy the same $1,560 worth of groceries, housing, and gas. And this is what it is down here in your cost per year. Nobody teaches people that. They a lot of times they disregard taxes. You go at the gas station and you pay your $47 in gas and you think that it's there, but you had to make $57 or $60 to pay that gas because of the taxes that they take out of that.
Exactly.
So I hope everybody understands that part of it. So I've broken it down into 4 basic types of income, right? I think colleges teach you to go to school, learn something, and then go work for somebody, right? And when you do that, the IRS calls that earned income, and that you'll either get a W-2 or a 1099 at the end of the year that your employer or contractor said, hey, you made this, and they're reporting it to the government so that they know how much people paid you, right? And you'll pay up to 50% or more in these taxes, right? Why? Because you pay the federal tax, you pay the state income tax. Pennsylvania has it, Ohio has it. Some you pay local income tax. You pay Social Security and Medicare. If it's your own company, that's 15%. If not, it's 7.5%. So it's pretty easy to get up to 40, 50, 60% of your income, depending on how much you make. So if you make 100,000 and it's an earned income over here, most people are going to end up paying around 40% of that when you consider all the things that are in there, Social Security, Medicare. And not a single one of those people ever help you get a raise, but as soon as you get a raise, they get a raise too. So the more you make, the more they take.
That's right.
So that's why I think this is probably one of the worst types of money. The second type of money is I like passive income. And guess what? Interest on notes is passive income. Rent money coming in on real estate is passive money. Dividends, right, is passive money. It doesn't mean that you're not working for it, because I'll tell you, sometimes you got to foreclose on notes, sometimes you got to sell them, sometimes you got to deal with tenants if you're in real estate. But right off the bat, you get to keep your 15% from Social Security and Medicare, and you get some other breaks a lot of times if you have rental property, some depreciation, etc. So out of that 100,000 that we said you made, if you made it in passive income, you make approximately 15, or you get to keep 15% more. So between earned income and passive income, I want to work less and make more money, so I'll go to passive income. The third thing is tax deferred income like a traditional IRA, right? You pay 0% now until you withdraw it, right? So you get to keep your 100,000, but when you go to withdraw it, you're back into paying the federal and sometimes state taxes over here. So this is good up to a point, and this is probably where I would work most of my money. But my favorite is the tax-free income from a Roth or an HSA, and because after you get that 100,000 in there, you pay the taxes on it. But if you make 100,000, you keep 100,000. So it's just, there's no rocket science in this. It's basically pretty straightforward, but nobody teaches you these things, right? I've never seen a single class in any university that tells you about this type of thing. And most accountants leave it up to you to figure it out. And even a lot of them will say, hey, defer it because you don't know what taxes are going to be like in the future. So that's kind of why I try to put anything that I don't have to live on in my Roth IRA. Does that make sense to you, Donna?
Absolutely, and I agree wholeheartedly with you.
Okay. So this is kind of a blueprint for myself, and I just pass it on to your contingent there. You'd pay income tax, let's just say you need $100,000 to live on, and you can make $250,000 a year, right? Mm-hmm. So, especially in notes. So you go out and you make 100,000 with your notes, and you pay your taxes on that because you're using it to live on. But the other 150 you do in your Roth IRA, and you don't pay any income tax on that because it's in your Roth IRA. So you do that every year, and just think about how much money you're building up in that Roth and how much quicker you can stop, doing things and, or what I say, quote, retire, do whatever you want and have all the time you want, because now you have this tax-free income for life for yourself and your kids and your grandkids. That can go for a century. So most people don't think like that. They're always working on trying to get more in their W-2 and 1099. Just forget about that. Get what you need, make what you need with what you're doing, pay your taxes on that, and then do everything else in a Roth IRA, if that makes sense.
I totally agree. Good advice.
All right. So here's the other thing that I want to kind of show is, look, it goes along with that graph where we are, and I hate to do this to people, but my engineering background makes me work on a lot of spreadsheets, so forgive me.
This is great because it helps us to see. I think a lot of people really like the graphs, so I'm glad you did it. Go ahead.
All right, so here's an initial investment of $100,000, right? And I'm just assuming we're in a 30% tax bracket, not 40 like I said before, but the 30% tax bracket. And let's just say we take a person, 40 years old, that's 20 years from retirement at 60. If they take that 100,000 and they put it in a 5% taxable income account, whatever they can do for that, they would end up with 198,000 after 20 years. That's not going to make much of a dent in your standard of living. If you put it in an IRA at 5%, you're going to have, $65,000, $67,000 more by putting it in an IRA. Still not there, but we don't want to work in this 5% range. That's not good enough for us, Don. I don't think you want to do that.
I agree. Absolutely.
Right? Mm-hmm. Most people are happy and can find investments at 10%. If you did this for 20 years at 10%, that same 100,000 would be 386. If it was in an IRA, it'd be almost double that, right, at 672,000. It's getting better, but I don't want to do anything less than 15%. So I move it to 15% in 20 years. It's 736,000 or 1.6 million. So I want people to understand that you want to look for better returns, right? 15% or better, 10%. At least that's what I do at this point. And you're at 1.6. If you have 30 years to do this, you can see that 6 million is going to make a difference in your lifestyle, right? Even $1.6 million may make a difference a lot more than 265 or 198. So I just want people to see this. Again, not many professional advisors will tell you this stuff because they don't get the 15% returns. They don't know ways to do that. And if they do, they take a lot of it. And that's why the feds a couple years ago had to start telling people where they're making their money. So that's one of the reasons that we're here. And obviously we don't take any from it. Your investments are your investments. You find them and you invest in them, and it's completely transparent on our side.
You know, if I could add one thing here, just so that my listeners can relate to this, we often start out with a 10% return if we're buying a discounted note, but we negotiate early payoffs. We look for notes that are going to pay off early, and when that happens, Carl, as you know, it's not unusual to get 50, 60, 70% rates of return for real. I mean, and this is not some pie in the sky thing. This is on a regular basis. And so even if that is the strategy that you're using, then it's okay to start out at a 10% return, but ultimately you're going to wind up with even way more than even 15%.
Sure. And if you take one of your grandkids, and they got 40 or 50 years and you put 100,000 in for them, look at what they're looking at. 26 to 108 or even 4 to $11 million, if they've got, 40 years in front of them.
Exactly.
So, that's a nice gift to leave to someone. And, you've worked with Dave Van Horn. He's another one that can kind of, and his clients can go and tell you how, what type of returns they're making as well. So
the one thing that I have found is that you make a much higher rates of return on notes than you do the real property, and that's why I prefer the notes.
Yeah, no, I'm with you. I'm moving way towards that part of it. It just depends. Sometimes you got appreciation in some areas, but again, the notes are a lot easier, especially as we get older, Donna.
I agree with you, and I didn't mean to imply no real estate. I think that you need to have a balanced portfolio, and you want some real property for the appreciation and that kind of thing. And if it were outside of the IRA, you'd want it for the tax deductions. But overall, exactly what you said is right, that the notes are so much easier and you get a higher rate of return. So. But
Right.
the beauty is that everything that I teach, I know, whether it's real estate or notes, can all be done in the self-directed IRA. So people can, make their own choice.
Absolutely, right. And the other thing that a lot of people don't understand is, well, how can I get my IRA up? You can only put 5,500 or 6,500 in it a year. And some you can put that amount in, some you can put 60,000 in, depending on the IRA, and we'll talk about that shortly. But contributions have limits, earnings do not. So you can make $100,000 a year in your IRA off of interest or rent or both, and that doesn't count as your contribution. And that other example with the 16,000. They put that in one time, and that's what the money is. This is 100,000 in this thing, and I'm not putting any more money in, and for the rest of these years, that's just what that is. If you started putting in more contributions, you would, increase this a lot.
And I'll tell you, I just taught an all-day Saturday, and one of the examples I used, a real example, was use your IRA to buy an entire note, and we take $100 as earnest money out of the IRA. So that's all that the IRA has invested in it. And then you sell enough of the note, like just part of the note, to cover the purchase price. And then the entire remaining part of that note stays in the IRA. And I know I don't mean to get into the details of it here, but I just want to mention that's a great way to build your IRA. Some of the advanced strategies that we teach with notes will really multiply these numbers even more,
Absolutely, and there's the wraparound mortgages that a lot of people are talking about. So you're 100% right, Donna. And this is just kind of, I want people to understand the power of the tax-free investments here, right?
Right.
So if your biggest expense is taxes, this is kind of what I look at, around to see what are deductions. And quite frankly, I'd never get married for the deduction. I'd never have kids for the deduction. I mean, they cost you money a lot more than what you're going to get deducted. Home mortgage interest, I'm taking it because they give you that, business expenses, etc. But today I'm just talking about these tax-free and tax-deferred plans. These other ones, you guys, who's ever listening, can go out and work with those. So let's just talk about the tax-free accounts today. And I want you, when you talk to your advisors or your accountants, because they're going to always tell you that now's not the right time to have to pay your taxes on the Roth. We want you to defer, defer, defer. If you believe that, if you believe taxes are going to go down in the future, then maybe you don't want to do this. I personally think they're going to be going up. Although Trump supposedly got them down this year. But I always ask the accountant, would I like to pay the tax on the seeds or on the crops? And that slows them down enough to say, hey, this is what you want to do. If you really want to get a Roth IRA and your accountant's talking you out of it, call us up. I'll give you a number at the end of this presentation, and we'll do a conversation with your accountant on the phone, a joint or three-way call. So just let us know.
That's great. That's good.
So, but this is a good thing just to slow your accountant down, because he's always going to tell you to defer, or most of them that I do. So here's the types of plans that are tax deferred on the left, and the tax-free ones are on the right. My two favorites, or my three favorites, are the top one, the Roth IRA. The health savings account is probably the best, because it's tax deductible going in and tax-free coming out when it's used for medical expenses. And then the Roth 401k, I like that. In 2006, they started allowing that to happen. And you can get, $50,000, $60,000 in there, depending on what your age limit is. And then Coverdell's are the educational ones for the kids. The only reason this isn't one of my favorites is because it's got a real low limit of $2,000, excuse me, in contributions every year. But try to have as many of these plans as you can. Think about converting them to a Roth IRA if you have some of the tax deferred accounts, and for the reasons doing that. I just wanted to tell people what a self-directed IRA is. Wikipedia has a really good page and a half definition of it. I try to keep things simple, as Donna knows. So an IRA is invest in anything you want except for collectibles and life insurance. That's what the little asterisk means. So anything that you think you can invest in, but collectibles and life insurance pretty much is allowed. What your advisors think of what I just told you on all this, most of them are going to say, hey, I don't think you can invest your IRA in there. It's not legal. I think it's too risky and it's very complex. My answer to them is, yes, it is legal. Just Google it. There's books out on it. There's articles out on it. There's IRS publications out on it. And we can give you all those. Just, write us an email at info@CamaPlan, and we'll give you that. Is it too risky? The answer is, the risk comes from what you invest in, not from having it in a self-directed account. All your money in a self-directed account with us is put in an FDIC insured account. So what you pick to invest in is where the risk comes in. Is the stock market risky? Yes. Is real estate risky? Yes. Are notes risky? Yes. But you should understand it. You should know. You should educate yourself on whatever you're going to invest in. You should have experience and knowledge in it. Experience and knowledge in any investment in my opinion, reduces the risk. And is self-direction very complex? I don't think so, but I've been doing it for a lot of years and I have my own company. But if you do feel it's complex, we're going to help you get through all the paperwork. You're still going to have to pick your investments, but we're going to help you get through the paperwork and invest in what you know and understand. So that's kind of my answer to what your advisors will say when you bring this up to them or show them this presentation.
You know what I say about the advisors that are telling people not to do the self-directed IRAs? They don't know enough to be embarrassed. I mean, it's a matter that they have no idea what they're talking about. You know what I mean?
Well, yeah, but the other side too, Donna, is these people are making their living off of your money, and if you take it out of their account and move it to us, a lot of them don't get paid on
They don't
that,
get a
right?
fee. Absolutely.
They don't
I
get a
agree.
fee, so they've got to take care of themselves first, and their family second, and you third.
Yes, you're right.
You know,
You're
but
right.
all of us do that, right? I mean, that you have to take care of yourself, otherwise you can't take care of anybody else. So here's kind of why self-direction works for our investors, right? It gives them tax-free income for life. They get to use tangible assets. So even if you have a note, it's tied to a piece of real estate. And I know if, you know, with that note, you're on the insurance policy as the mortgagee. And if the house burns down, right, you get paid. So people like that type of confidence that's in there. You know, access to the managers. You get to see who owns the house, right? You have more control. The fees are less expensive. And to me, it's the only way you can get real diversity. If you're in the stock market and the stock market goes down, in 2008 and 9, we saw pretty much everything went down. But if you have stock market and real estate or whatever else you're good at, notes, then I think that's why it works. And the fact you can get that tax-free income. How it works for investors, right? This is all you have to do to get that extra money is, right? Open up a self-directed account, you know, hopefully with us. Fund that account with your money with a transfer or rollover or contribution. It doesn't matter. Figure out, you know, do you want to buy a piece of real estate or do you want to buy a note or do you want to take, you know, go in with Donna on something? Your IRA can do all of that stuff. Your IRA is a separate entity from you. We'll sign the documents for you or for your IRA when you tell us you like this deal. And then you'll go online and every month you'll see your interest payment come in or your rent payment come in, depending on what you want to buy. And if they don't, you're going to call up the borrower or the renter and say, where's the money? So it's pretty straightforward, and that's why, you know, investors kind of like this, because they're getting to do what they know and understand.
You know, if
So
I could interrupt for just 1 second, Carl,
sure.
you mentioned something important there. A lot of people think that we're talking about taking the money out of the IRA, investing in something, and then putting it back in. And I get questions like, oh, don't you have 60 days to do that? And it's important for them to understand that your IRA is actually taking title to the investment. You're not removing money from the IRA. It is your IRA that is the entity that owns the note. And that's a lot different than
No,
taking it out.
that's a great point, Donna, and you're right. So many people mix that up. But just think about it. The money does go out, but so the money also goes out when you buy a stock or a fund, right? It goes to you know, your cash goes out of your account and you get a stock back in, IBM, Apple, Facebook, whatever that is. So all we're doing is giving people more assets to choose from, right?
Exactly.
If you go to your stockbroker, you're going to pay for a stock or a CD or whatever, right? So, or a bond, and that's the asset that goes into your account. With a self-directed, you can do all those, but you can also buy the house next door, you know, a piece of raw land. It doesn't matter. Precious metals. You can buy a first or a second note or a third note. You can make up a new note. You can buy into a business in town. You can buy into an investment club or llamas or goldfish or horses. So there's all kinds of things that you're doing. So that's a point well taken. Everything is in the IRA, and then when you buy that house and you sell it, all the money's going back into the IRA, just like when you sell a stock, and you're not going to pay any tax on it when you take it out if it's in a Roth.
Absolutely.
So the IRS requires everyone to use a third party to open up an IRA. You know, you can't open up your own IRA. You have to go to a bank or a company or somebody's authorized to do that, right? We're a neutral third party. We don't give any investment advice, and different from Schwab and Fidelity and all the rest of them is we don't have any products to sell. When they tell you they have a self-directed account, you know, at Schwab, Fidelity, Vanguard, etc., it's self-directed in whatever they sell. So whatever they sell, you can pick from. In our case, we don't care. That's totally up to you to pick what you're going to invest in. And then we specialize in providing the IRS with the forms that all those guys do too, you know, such as the 5498s and the 1099s. So that's our job. We're basically bookkeepers so that individuals can have more control and pick their own investments and have a decision on their financial future using these tax-free and tax-deferred systems. So can you have a Roth account? People say, what is it? And basically there's two simple qualifications. One is you have to be alive, and the other one is you have to have earned income or have an existing IRA or an old 401k somewhere. So that's the only two things you need. The other argument I've been hearing a lot is, well, my accountant says I make too much money to have a Roth IRA. Well, that's not really true anymore. You may not be able to contribute to one, but you can convert to one because back in 2010, they dropped one of the rules that said, hey, anybody that makes over $100,000 can't convert. So now it's very easy to convert another IRA into a Roth IRA. So don't fall for that. If somebody tells you you make too much to have a Roth, again, get us on the phone. We'll be glad to help any of your listeners out there, Donna.
Great.
So let me just kind of go over why I think this is important. Isn't that a picture of your grandkid?
It's not mine, but I sure love it. Yeah. He's a cutie pie.
Yeah, he's going to be successful, I think, right?
I think so.
Right. So once you have the Roth IRA, to summarize here, you basically eliminated the tax rate because you've already paid your tax on the money going in. So everything else you make, you get to take out tax-free. Who cares where the tax rate goes in the future, right? You're in control because you're making the decisions on what you're going to invest in, when you're going to buy it, when you're going to sell it. You're not tied to things like 1031s where you have time limits on it. You have a lot more options available, right? A lot more diversity. We just talked about everything that most people don't even believe that you can do in it. And this will go tax-free to your kids or your grandkids and their grandkids if you set it up properly. So start this right now. I haven't seen one person that has a Roth that wishes they didn't. I've never heard that yet. The other one that I didn't talk about is when you make contributions to a Roth IRA, you can take them out at any time. Okay, so you don't have to be 59 and a half. They don't have to be in there for 5 years, but they are a nice account to put money in because if you ever get sued, your Roth won't be attacked by any creditors. So it works as a great savings account if you need it, and everything accrues tax-free. It outlives you for over 100 years, and you don't have to take money out of it. People say, well, why doesn't the IRS make you take money out like the other ones? Well, the main reason I think is because they're not getting any taxes. You've already paid the taxes, so they don't care, right? And if it goes to your kids or grandkids, they don't have to pay any taxes on it either. and you can contribute after you're 70 and a half. So I feel like I'm still in good shape here, and I'll be kicking around at 70 and a half. So if I still want to work and make money, I can still put more money into my Roth IRA, where the tax deferred plans, you can't put money in there. I know I'm running over a little on time today, Donna, so let me,
You're fine. You're fine. Absolutely.
okay.
Keep on going.
All right. Well, let me just kind of cut on this, because we're going to do another webinar, and we'll talk about a lot more things at that point in time. But if people need a question, let them come down, and call us up, etc. Call me or email me and my staff at info, and if they can't answer the question, they'll come get me. Call our phone numbers here. One's toll free and the other's direct into the office, or both are direct in there. Or schedule a free phone consultation with us and your advisors or accountants. We don't care. We love that. We want you to bring them in. We want them to understand what you're doing. We don't want anybody to have anxiety. And enjoy yourself at this network, and ask questions. It would be my parting words to people. Do you have any questions on this, Donna, that I should have answered?
I think you were great. I really appreciate everything that you said. The one thing is, you were just now talking that I thought of. I always tell my students that they should get their IRA set up right away, their self-directed Roth IRA, because I think they need to have it in place so that when they do find a deal, that it's all ready to go and they don't have to wait to get it set up, especially if they're transferring funds from another IRA into their self-directed IRA. Do you have any comment on how that works with your company?
Yeah, Donna, that's a great question. And we've had people lose deals because they couldn't get their money here fast enough. I think we're the only company out there that doesn't charge you a fee until you've actually done a deal. So we want people to get their money here. We want them to have at least enough money to get into the deal, open up their account. We don't charge an annual fee like all of our competitors do when your account is opened. But so just bring your money over. There'll be no fee. And when the deal does come through, you'll make, everything will be set up, and you can concentrate on your due diligence and make a good purchase. That's more important to us than people worrying about getting the money over, because I have no control of getting the money from Vanguard or Merrill Lynch or Bank of America. We have to send a transfer over to them, and they take their time. I've even seen them call up clients and say, hey, we'll give you 3 free trades, if you stay with us. And meanwhile,
I believe it.
Meanwhile, they lose a deal that they're going to make 15-30% on. And one of the things, as if you tell somebody, hey, I have the money and I can close quickly, a lot of times you'll get a discount just from being able to do that. So
absolutely. That's for sure. Carl, I've seen some of them where they're transferring from one IRA to another. I've seen them take as long as 6 weeks. That's unbelievable.
Yep. No, that's exactly it. And, and everybody thinks it's a lot of times they'll think it's our fault. And I'll just say, hey, we call them up and they say they don't trust your signature. They're still trying to get a hold of the client. And, so I find that it's better if a client, we send them an email that said, hey, we requested the transfer, see if you can push it along on your side of it. And so that's basically, I agree with you 100%. Get the thing set up. Don't worry about the little bit of money, especially if the money's in a CD. People say, oh no, it's in the market and it's making 8 or 10%. And I said, yeah, until it's not, or until it's losing 8 or 10%. So I can't read the market. I'm not very good at the stock market at all. Like I said, my family and grandparents were in real estate, and myself and my sons are in it. So, we're down to at least 4 generations in real estate and notes. So that's where my money's going.
I'm absolutely with you 100%. So, well, Carl, thank you very much for taking time out of your busy schedule to be with us. I know everybody was thrilled to hear what you had to say. And I just want to encourage you, if you do not have a self-directed IRA set up, please reach out to Carl at info@camaplan.com and they will help you to get it set up. And I would also mention, if you're set up with someone else and you're not happy with the service, by all means, reach out to Carl as well, because I promise you, you will not be disappointed in the service that you get. They're very, very investor friendly, especially when it comes to real estate and notes. They will help you. They make it easy. Carl, you don't have a lot of the red tape that some of the companies have. And I will tell you that when one of my students come and they want to invest in one of my notes and they tell me that their IRA is with you, I just smile real big because I know that I'm going to be able to get that closed in no time at all. And that can make or break the deal. Like you said before, a lot of times you're offered that higher rate of return because you can act quickly. But if you don't have your IRA funds in a company like CamaPlan that appreciates that the necessity of acting quickly, then you could lose the deal. So I encourage you to get a hold of Carl or his staff at camaplan.com. I know you won't be disappointed. And Carl, I look forward to us doing another one soon where we can talk about some of the advanced strategies. Okay?
Yep, no, that would be great, and we'll talk a little bit more on you know how people are using theirs today and what you can do with a little bit of money and things like that. So, Donna, I appreciate all those great words about our company. You know, it was set up by investors for investors, and I appreciate the fact that you see that and understand it. And again, I look forward to setting up another call with you. Thanks.
Sounds great. Thank you very much. And happy investing, everyone. Until next time, take care.